Well, hello everybody, and welcome to this Genesis Conference Innovation Workshop. I'm delighted to have the opportunity today to spend some time listening to and chatting to Tim Davies from London Stock Exchange. I've kind of felt like lots of people, I think that the success of London's capital markets is one of the best kept secrets that we try to get rid of as a secret, but actually not try to get rid of in its reality, because things are changing. There's already successes going through London, and it's a real major player when you look across Europe or inward investment. It is such a brand, it's such a hub, and it's time that the life science sector and others probably stood up and noticed a bit more. So I think it's refreshing to see that Tim is willing to come and present today on the actual data rather than the myths. And I'll hand over from that to Tim and let him tell us why London is the place to be.
Great. Many thanks, Tony, and thanks for inviting me along. Look, I'm going to start by saying something which may seem a bit strange given where I come from, but IPO is for the few, not the many, ultimately. And what we see increasingly, certainly over the last 3 to 5 years, is the number of companies who are making a point of looking at it as one of the predictable options in terms of the where next, how next funding the growth path. And then over time, discounting option after option, then ending up with the one that feels right and looks right for the company. My job is to help companies determine whether they're right and also do everything to educate and inform to make sure that founders and management teams really understand the option. And there's no in fact, there is no hard sell on our part, because what we want ultimately is to have the right companies listing for the right reasons and right motivation. And then there's an overlay on that with what we call healthcare, which is everything from pure therapeutics at sort of this end of the scale through to platform businesses, manufacturing, services, tools. So we call it healthcare. So when you hear me mentioning healthcare, don't think of anything in isolation. It's the broad brush umbrella. So look, I've got a presentation which I'm going to whip through. I'm going to pull out what I think are the interesting and relevant points, but the main point I'd like to make is that my role is about interfacing with companies and helping them understand this particular option. I live in the middle of the UK. I divide my time between London, Oxford, and Cambridge, so I'm very much available if you wanted to have a quiet chat, even if it's a sort of what-if type conversation. So without further ado, first slide, please. Okay, and the next one. Okay, so here is the London. Oh, well, I've gone too far. Here is a snapshot of what the London capital market looks like in the round. We divide it between equities, bonds, investment companies. I draw your attention to the left-hand column with the 4.8 trillion of value, which is the cumulative value of the companies on the market. Next slide, please. And the next. So here is what the healthcare sector looks like. So we've got 140 odd companies, and the value in terms of the billions is up there as well. The point I'd like to make about this is that if London has a particular edge when it comes to listed companies, it's much more about the what we would call the growth stage. So the sort of 10 to 50, 50 to 100, 100 to 500 million in value. That's not to say we don't have sector companies that are worth more than that, but as you can see, the mainstay of the companies we have by number are within that value band. And that's a very important point to make at the outset, because if you look at healthcare in the round on NASDAQ, if you are thinking of listing and your value at IPO is less than, wait for it, $1 billion, or ideally 2, or ideally 3 billion, then you'd have to think very carefully about IPO being the right move at that time, for reasons we'll come on to. But to make the point loud and clear that London is very, very well known, and we have a large number of growth companies, both in UK and overseas, listed on our markets. Next slide, please. And here are some names, if you just want to run your eye over them. We've got everything, I say, in value terms from the quite small up to the very largest. Next slide, please. And now just to give you a feel for what's going on in the broader market, because this is something that we're asked every day. Next slide, please. So if you look at the top line, the top half of the slide, it rather implies that, oh, look, FTSE 100 is performing better than everything else, including the S&P. Actually, that is a fairly consistent image in that whichever way you measure it, London UK as an economy and London as a market actually is in quite good shape, certainly compared to the other global indices. And similarly, if you look at the volatility and the stocks down at the bottom, sorry, the VIX and the stocks, if you look at the bottom there on the right-hand side, volatility is starting to reduce. We're not in the business of providing economic forecasts or making great pronouncements about calling the economy. But what we do is listen very, very carefully to what investors say, what other stakeholders in the market say, what regulators and governments say, and so on and so forth. And if I were to give you a sort of summary of what the general sentiment is at the moment for the UK, I would say it's something like this, which is that there seems to be a view that, yes, there is going to be a change of political administration, but there doesn't seem to be a huge amount of concern. The alarm bells aren't ringing in terms of what can usually happen with a Labour government coming in, which is usually tax and spend and rampant inflation. What we've got now is an opposition which is largely endorsing current policies and making it clear that they're not going to upset the status quo. So that is itself quite helpful and promising. And then if you accept that inflation is starting to come down, and it comes down on not just a month by month, but hopefully a quarter by quarter basis, and with that interest rates, so we'll see the market start to respond accordingly, the equity market. And so again, the view seems to be the further we get into Q1 and into Q2 next year, then we should see that recovery become more evident. Next slide, please. This is just looking at the inevitable on the right-hand side in terms of when you are in more challenging economic circumstances, investors switch out of equities, out of the market, into the money markets and bonds. Surprise, surprise. But on the left-hand side, I thought this would be interesting. So this is looking at 2023 year to date in terms of the switch from to more defensive sectors, and healthcare, it turns out, actually has done surprisingly well. Next slide, please. When we talk about London, we talk about it generally in the context of London against European and Scandinavian markets, as opposed to the US, because it's a fact of life, the US markets are just much bigger. Whereas in the UK and in Europe and Scandinavia, they're more comparable. This bar chart, or these bar charts, I should say, change little over time, year on year, in that whichever way you measure London in the context of Europe and Scandinavia, we are by far and away the biggest, and also the most productive in terms of numbers of IPOs and the amount raised in terms of follow-on once companies are on the market. 17.7 billion raised year to date so far. Just over $1 billion of that has been across 23 IPOs. Inevitably, quite a depressed number, but then look how difficult the conditions have been. But there are a lot of people out there who think, oh, there hasn't been a single IPO in London, but actually there has. And more to the point, a lot of money is being raised on the market by existing listed companies. Next slide, please. One of the reasons why we think London continually scores highly against its peers is because we have an extraordinarily large amount of mandated assets under management. Put another way, those are funds which are mandated to list in UK listed equities. And again, that bar chart, the numbers may change, but the bar chart showing London's superiority changes little. Next chart, please. Next slide. Another reason why London turns in robust performances year on year is that we give investors extraordinary choice in terms of the numbers, types, sizes, stages, sectors, subsectors of companies. And so it follows that at any one time, roughly 1/3 of the trading companies listed in London are actually from overseas. If you turn that on its head, what it's telling you is that investors of all different nationalities and origins that invest through London are comfortable investing in foreign companies listed in London because they know that the regulatory regime is fit for purpose and also the liquidity generally in terms of the availability of capital and the ability of those institutional and other investors to trade through London is very, very high. So it's a very liquid market. Next slide, please. And this is one that arguably causes the most interest, because we know that, again, across the broad healthcare sector, there is an association between the common business objective of the business being predicated on the US markets, or conquering the US markets, if you like, and also to achieve that, having US capital. Actually, that's a misnomer, because with a London listing, you can, for the right companies, attract all of the US and ex-UK capital that you seek via London. And the two pie charts at the top, the left-hand one shows you the capital employed in the FTSE All-Share. So that's across all sectors, all shapes, sizes, development stages. The actual money invested in those companies, 40% North American, 39% UK. Compare and contrast to NASDAQ and NYSE, where it's a far more introspective or inwards-facing market or markets, whereby funds are often mandated only to invest in US-listed companies rather than the other way around. And we'll talk about some of the characteristics of the markets later. But if you look at the bottom half of this slide, again, it's telling you who are the biggest investors in the UK. Well, look at that. 3 of them are US. Next slide, please. This is very recent indeed. So if you look at the right-hand one, that is all global exchanges in terms of where we have come from in the last couple of years and where we're hopefully going in 23. I caveat this in that when you're looking at the vertical axis on both the UK and the US, obviously the US is 4 times the size in terms of number of transactions, but nevertheless, look at the trends, almost identical. So if you are a subscriber to the belief that if the US markets are picking up, then the UK follows, you're probably not wrong, but the reality is actually we are tracking each other at the moment. What's also noticeable is that healthcare, particularly biotech IPOs, have restarted in the US, albeit they're few in number, and also they're being done at, shall we say, real world, in some cases, quite heavily discounted pricing. Next slide, please. And again. So we have 2 principal offerings. We have AIM and the main market. The main at the moment is divided between premium and standard. There is a lot of regulatory, shall we say, evolution and development going on in the background at the moment. One of those which has been made public is that main and standard, or premium and standard, I should say, are going to be merged into one listing, and we're waiting to see what the detail of that is. It's not down to us, it's the Financial Conduct Authority who decides all that, having consulted widely. So we're going to end up with, if you like, one main market, but also AIM remains, if you like, untouched in its 29th year, owned, operated and regulated by us, and it was conceived and remains to be arguably the world's premier market for growth stage companies, and the rules and regulations are written and maintained by us, and we try to make it as simple and as user-friendly and as pragmatic as possible in all respects. Next slide, please. And there is AIM in the round. So what I was talking about in my preamble about size of companies and London being the place for growth companies, if you look at that in terms of the left-hand side, really speaks for itself. Interestingly, 72, so 10% of the companies listed on AIM are from North America. And over the last 2 or 3 years, we've had, I think, 15 healthcare and science-based North American businesses list on AIM. And it is as straightforward as you put in place a new topco and effectively become a UK company, and the rest goes from there. The typical value proposition on AIM companies is pre-new money. So at the point of IPO, but pre-new money, they're typically somewhere between 50 and 75 or 80 million, raising 15 to 50 and coming out at an average of about 115, if you like. And again, you can see from the top and the bottom of that chart how the size has got bigger. And that's reflecting actually quite a few things. First is that companies are staying private longer, using more private capital to get where they are pre-IPO. But the other thing is that the institutional investors who support AIM are looking, in some cases, are looking for bigger ticket sizes than before. Again, they're changes for the better. Not to say the bar is set very high. We think the bar is set at a very pragmatic level. Next slide, please. And here's just some more stats to look at. The pie on the right in the black element shows you how big healthcare is when it comes to AIM, bearing in mind there's 800 odd companies on there. And also on the right-hand side, it shows you that admissions, the number of admissions year on year has actually shrunk compared to 10, 15 years ago, because there are fewer, bigger, and I wouldn't say better, but more developed companies coming to the market. Next slide, please. This one again reminds us, if you look at top and bottom on the right-hand side, main market versus AIM, there is extraordinary commonality in terms of the names of the institutional investors in particular. You may not be aware, but the other thing about AIM is that from the start, from its conception, we worked very hard with the Treasury and built into it our whole host of tax efficiencies, both for existing investors, founders, management teams, but also incoming investors. So all of the acronyms apply: CGT, IHT, VCT, EIS, BPR, you name it, it's there. Extraordinarily tax efficient, and there is literally nothing like it anywhere else in the world. The market cap bands on the left, so this is market value against AIM versus main market. And again, I draw your attention to the 50 to 100, 100 to 500, 500 to a billion, which is where increasingly companies are listing rather than necessarily listing on AIM rather than necessarily proceeding straight to main market. Next slide, please. One of the observations of AIM has always been, well, historically has been, oh, it's a liquid, you can get in, but you can't get out. Actually, that's not true. And these stats rather prove the point that actually AIM is on a par, or in some cases, in the 100 to 500, more liquid on a daily basis than the main market itself. Next slide, please. And again, the investor base is truly, well, global, not just international. So the bright blue, sorry, the French blue, as I'd call it, the mainstay is UK, black is North America, and the yellow is Europe ex-UK. So what that is saying is that institutional investors are increasingly active with AIM companies, but it doesn't follow that every company will attract that international investment, if you like. The beauty of AIM is that there are no two companies the same, and therefore it follows that the cap tables of the shareholder registers, no two companies are the same either. Next slide, please. And this is AIM and healthcare. So this is one just to dwell on a bit. So again, if you look at the North American element, 27 versus 53 against the UK, but just run your eye down the right-hand side, because what you've got is a combination of blue chip institutional funds, you've got US investors on there, and also you've got the venture capital investors too, and family offices. So literally all shapes, sizes. Next slide, please. Strong feature of AIM is that, again, we made it this way, and the rules say as much, is that we made it incredibly straightforward for companies to quickly return to the market and raise fresh growth capital post-IPO. There are some ground rules in place in terms of class tests, but they're very simple and, relatively speaking, light touch, certainly compared to the main market. It's not unusual for companies to do accelerated book builds within a week, within a working week, and money in the bank days later. It's very common indeed. Next slide, please. Next one. Now, this one is self-explanatory, and this is not us being very defensive. This is so. Some of this data is ours, some not. But just look at the differences. I think the main point to make on this is that listing in the US is far more complex, it's far more onerous, it is far more expensive, and it comes with many, many more strings attached, some quite obvious, some less so. The main points to have in mind if you're a UK company thinking about listing, and indeed listing venue, UK versus US, is that again, the US is just a far more complex, far more bigger, far more strings attached version than the UK offering. But specifically, companies listing in the US have to be very US centric. And by that, I mean, I take you back to what I was saying about value, the sort of size you've got to be in value terms to even contemplate listing. So I would say $1 billion plus, preferably more. And the second thing is US-centric investors, and bearing in mind most of them only invest in US companies, need to have a reason to buy in the first place, and specifically a reason to buy, in this scenario, a new entrant, rather than buy something which is already on the market, which is already listed in the US. The other thing is that from a director, C-suite point of view, is that it is an extraordinarily litigious environment. Class actions are order of the day. I refer you to the bottom line, where in the UK it just doesn't happen. But also Sarbox is very much alive and well. So I put it to you that although people talk sort of generically about NASDAQ being synonymous with IPO, IPO in the UK and IPO in the US are two very, very different offerings, and they need to be understood. Because again, I bring you back to where I feel the UK scores much more highly, which is if you are in the sub 500 million, certainly sub billion, there is no reason why you can't list, if indeed listing is the right thing for you and the business and your existing shareholders to be doing, in a more benign environment where, as I have hopefully amply demonstrated, you've got adequate choice of capital and also, relatively speaking, easy process to raise more money, and also secondaries, which we'll come on to in a minute. Next slide, please. Yeah, now secondaries, this again is a very important consideration, not just for founders and management teams, but also third-party investors. And again, this is not just AIM, this is across AIM and the main market, but UK investors, when we talk about UK investors, we're talking institutional investors, get secondary sell downs. And again, there is no one size fits all. We've seen some companies list where there's been no secondary sell down. We've seen others where it's been very, very high in the 70s and 80%. But this just proves the point that the market, London market, understands secondaries. One of the conversations we have a lot with founders is, well, look, I'm here for the long term, I'm here for the ride, but I do want to take some off the table at point of IPO. And the answer is always the same, which is absolutely right, understood. You bought it this far, you carried the risk, it's right and proper that you sell down. But what the incoming investors will want in return is some sort of commitment, both skin in the game in terms of residual equity stake, but also in terms of time commitment to the company. And although it's never set in stone, realistically, you're talking sort of 3 to 5 years plus. Otherwise, they may take their money and invest in somebody else or something else. So secondary market alive and well. And the other point to make about secondaries is that as you go forward, you have the optionality to sell more into market strength, if you like, or alternatively to sit tight and then just take the dilution as the company goes forward, raising fresh growth capital. Next slide, please. And again, this is just to press the point about growth companies sub $1 billion in the UK. We are very, very much the place to be doing it. And I refer you to main market and AIM on the left-hand side. Those are, if you like, the average market caps at IPO over what, a 4-year period. And that I don't feel instinctively those sort of averages have changed much in the intervening years either. And there is also an argument which says that if you look at, the last couple of big sector companies to list, Haleon, which was a spin out from GSK, and also Oxford Nanopore. In both cases, they started life at 2, 3, 4 billion value. Part of the consideration was very much that they recognized that listing in London, they could be much bigger fish in a smaller pond and attract investor interest and sentiment accordingly. Next slide, please. Now, this is a piece of work we've done recently. Two things that we feel we have to challenge received wisdom on. One is the liquidity in the US, and the other one is valuations. This one is liquidity, whereby if you compare the FTSE 100 and NASDAQ at a headline level, then NASDAQ, of course, is 6 times the size in terms of number of companies, 10 times the value and all that. Although the reality is that the value of NASDAQ, the mainstay, is actually held by 7 companies. The rest of it is actually a long tail of increasingly small companies. So what we've done is deconstruct the whole market, and we've looked at how our various indices in London overlay. So with the 3 on the left, if you like, in the darker blue. And what we've done is done an exercise looking at free floats and adjusted turnover by index. So it's quite a complex mathematical exercise, but this is what it shows. The reality is that liquidity is broadly comparable, if not better, in London. On the valuation point, I haven't got anything on that because that's a whole presentation in its own right. What I would say to you is that valuations in the US are extremely volatile. They are more often than not based on a lot of hope and not necessarily a lot of science or mathematics. The UK has a very different approach, which is real-world valuations, which start at the point of pre-IPO. So if you're doing the exercise of looking at IPO, one of the things that you do is talk to 2 or 3 of the investment banks, London-based with international reach, strong in the sector. And obviously the early discussion is going to be around valuation, not just for you as the part owners, but also expectations of existing investors. And the way the London works is we still work very much on the more, as I call them slightly flippantly, real world valuations. But those are valuations which the investment bank think, all things considered, and looking at comparative businesses, different stages, and so on and so forth, you'll get a valuation range, often quite narrow, within which the bank think they can get the money raised and the IPO done. And then if you say, yeah, I think we can live with that, and our investors can live with that, based on the XYZ considerations, what they will also do is take you on test marketing to test that valuation thesis and the general offering proposition, if you like, on real live potential investors. So there is a lot more science to it in terms of determining what the real value is. And then as you go forward, deliver per plan, there's no surprises. And then hopefully it just becomes on a continuing basis, reporting to the market, KPIs met, funds raised, and everything else looks after itself. Next slide, please. This is one which, again, is quite important to understand, and I stress this is not our data. So this is, over the last 10 years, 22 UK companies have listed in the US and raised more than 100 million at point of IPO. This is excluding all the SPACs, which I'm trying to think of one that's been successful, but by and large have been car crashes. So these are plain vanilla IPOs, and look at the performance. So you've only got 3 or possibly 4 if you include ARM, which are above their IPO price, and the rest, as you can see, have gone to some quite considerable discounts over time, and the average is on the left. So what this rather supports is the mindset which says that overseas companies, and in this scenario specifically UK companies listing in the US, do not thrive. And certainly if you are on the smaller, and I say it again, sorry, stat record, sub-billion, life can be very difficult indeed. Next slide, please. So if you're a UK resident or you study the UK press and the wire services, you could be forgiven for thinking it's all doom and gloom in London and no one's doing anything, companies leaving in droves and so on. It's manifestly untrue. One of the big differences between the UK and the US is that, and this is very much a personal view, is that the press is, how can I put it, sometimes unsupportive of industry and enterprise. sometimes inaccurate. The problem is we live in an age where if something is put out on the wires or in print, it is around the world in nanoseconds. And so if you've got half a story or something which isn't quite right, it's perpetuated. But we've been living through this period whereby London Stock Exchange is, the finger is pointed at us for all sorts of things. The reality is actually we run markets. We don't value companies. We don't tell investors what to do. We're platforms, nothing more than that. However, there is another side to London Stock Exchange. Next slide, please. In that we have as I call it in simple terms, we have a place at the top economic table in the UK, arguably globally. And although we say we don't change laws, we don't tell people what to do, what we can do is convene. And what we can do is use our voice and use our connectivity wisely. So my boss, Julia Hoggett, pictured down there bottom right, she had the idea that against a backdrop of a sizable number of reforms around the whole regulatory piece, essentially to make the UK a more straightforward and more attractive place for companies to list, which is underway and continuing, she put together what is called the Capital Markets Industry Task Force, which is, if you like, apolitical. It is a business interest group, which happens to comprise a lot of chief execs and business leaders who share our beliefs in terms of what needs to change or what needs to be improved upon. So it is into, I lost track of time, must be 8 or 9 months of its initial 3-year lifespan. It has been, I would suggest to you, extraordinarily effective around the whole area of pension reform, which has been very much in the news. And the CMIT, as we call it, Capital Markets Industry Task Force, is now also very getting its teeth into the whole area of directors' remuneration, specifically the activities of proxy agencies, and how we can make it more straightforward and easier for UK-listed companies to hire people they want to hire without investors or proxy agencies saying, no, you can't, when, particularly in the US, people can hire who they want. So CMIT is trying to unpick all of that. Next slide, please. So here it is. I mean, this is a bit of an eyeful, this chart, but a huge amount has been completed over on the left. There is more to come in the middle. And then on the right, again, there are other exercises underway too. I'm not going to go through it now, but suffice to say, there is a huge amount going on, a huge amount has been achieved, and there is more to come. Next slide, please. This one is important because reference what I was saying about CMIT and pension fund reform. The Chancellor in his Mansion House speech, and then again in his autumn statement, has, in a sense, made a huge amount of progress on this topic compared to other administrations who have always talked in the round about the need for pension reform, but never actually got on and do it. What Mr. Hunt has announced is that the government is pressing ahead, but specifically off the back of that pressing ahead, the Mansion House Compact has been born. And that is a group of 9 life and pensions companies who between them have agreed to provide a pot of up to £50 billion by 2030, specifically for investment into tech, healthcare and UK tech, healthcare and life sciences businesses. And what we're waiting for now is for the mechanisms to be announced by which those companies will invest that money. But say the momentum is very much with us. We, among others, are sitting watching that space. And the other thing I'll just mention in passing, so I should have mentioned it on the CMIT slide, is that the other thing CMIT has done has sent a couple of open letters to the Chancellor. The most recent one was on the subject of the so-called UK ISA. Because at the moment, UK taxpayer, you can have an ISA, put 20,000 a year in it, and you can roll up any interest payments, no IHT, no CGT, and so on. And so our view is shared with quite a lot of other people, whereby we think that if the government or the Treasury is effectively giving us UK taxpayers the gift of tax-efficient investment and investing in this particular wrapper, then the companies we invest in should be in the UK. So we're reinvesting in ourselves effectively, rather than potentially investing in ex-UK businesses that happen to be listed here and so on. So that's another example of what we're trying to do to improve liquidity. But the main one for now is pension fund reform. Next slide, please. And that's me. So the slides will come round. Please do contact me, because IPO is a huge subject in its own right. I spend my time talking to companies from actually relatively early stage, where there is a business. It's not an idea, there is a business. And more to the point, it's a business which is starting to grow, starting to consume capital, needs to plot its journey quite carefully, because we are very much in an age where, and certainly in recent years, we've been through these difficult times when fundraising and everything else is taking much longer than it has before. So cash management is key, and also planning next stages are key. So I'll stop there, Tony. I thank you very much.
Thanks, Tim. I think it's just reassuring to sit here and follow that journey through, where there's so many of they're almost throwaway comments and asides in presentations or panel discussions at events that I go to or meetings I'm in, which actually are portraying a very different story to the one you just presented actual data for, which is kind of surprising when we work in an industry that's driven by data. But
yeah. I'll tell you what, if I may, Tony,
yeah. We lost him there for a while, I think.
That wasn't me. Sorry, the line, I don't know what happened there, it just dropped.
Yeah, I don't know.
I was just about to make one extra point, which is back to our umbrella term healthcare, and just to dwell specifically on therapeutics. It is true to say that in the US, the risk appetite for that specific asset class is higher than the UK. Also, that there is a lot more risk capital available for those types of investments. It is not to say
what's happening
I
again
think Tim's connection might be bad.
Seem to have frozen in time. Needs to come back in. Here we go. Coming back.
He has joined.
Yeah.
There he is.
Oh, no, he's gone again.
Oh, no, he's back.
There we go.
Apologies.
It's of technology. There we go.
It's not to say that pure therapeutic opportunities cannot be funded in this country. They are. We have a good number on the market already. Some of them are, without being derogatory, quite binary. They are about one particular opportunity, but it can be done. But again, to be measured about it, in the UK, things are done on very, very different valuation metrics, but they, generally speaking, tend to be more sustainable as well.
Well, and I think there is, you made a very interesting point right at the very start, where from your perspective, it's about finding the right companies that should be in the market. It's for the few, not the many. And I think, again, some of that detail and impression is lost amongst a number of companies who need to say, this isn't for you. Go and do something.
Because I do spend a lot of my time, some of the companies I meet, where you think really interesting, smart people, but it can be anything from, why are you actually thinking about IPO when surely it would make more sense to do it privately, and then it goes out to a trade buyer, or it's just too early to be contemplating IPO based on where the company is at in terms of development stage with its various assets and so on. So every case is different, but that is why, and there's me and other people around the world doing the same job as me, who spend their time helping companies really understand whether actually it could be right, and
Yeah.
what do you need to do to get it right in shape, get match fit, or
You
whether
know,
actually
which
barking up the wrong tree.
in essence, that's not any different to any other
No,
part of your commercialization planning. It's working out whether there's a market there for what
Yeah.
you've got to offer. You know, the
Yeah.
customers here
Yeah.
being investors, whereas
Yeah.
customers may be the consumer when you're taking it into is there a market there for your product in that particular location? That's not always a given.
Yeah.
One thing I wanted to just touch base because I think what's really interesting is obviously about where the exchange is and what's happening, but it's the kind of financing ecosystem that London has.
Mhm.
You know, from the great advisory services which have been there and delivered time and time again, and how we sort of scale that to some degree. You know, because it almost seems like, can we be informing and educating sounds a bit derogatory, it's not meant to be, but informing those younger stage companies and entrepreneurs and their investors,
You can.
generation.
I mean,
What
look,
can we do to help that?
Not to get off the point, and this is not a plug for London Stock Exchange, but we are corporately very much in the mode of introducing and building private funding capability, simply because, you know, we have infrastructures, we have platforms. They happen to be focused largely on public capital, but we are now doing the same with private capital. So that's us. But I think also it's true to say we live in an age where there is a huge amount of capital out there in lots and lots and lots of different buckets and pockets. And I've seen, even in the last 2, 3, 4 years, you know, the rise and rise of the so-called family office, the high net worth. And I talk to people, the advisors around this sector, certainly the investment banks that are very active, where they all have private capital arms and capabilities, whereby if it's a company which is not interested in IPO but wants to raise capital, they can probably help. Or actually IPO, but 18, 24 months time, great, pre-IPO raise.
Yeah.
So, and that has become quite big business. And again, it's not just UK money, it happens to come through London.
Yeah, I think the other side of it, you touched upon the pension reforms announced, and I think it's, you know, very positive news and very exciting times. Within that, do you think the way that ultimately might be deployed, is this details is still yet to be fully worked out, and we've seen some of that emerging? Are they going to be sort of replacing, or is that do you think that will replace the sort of, or bring in crossover investors in a way that?
No, the crossover is a slightly emotive US term. Funds that can write those sort of checks, which is pre-IPO in our parlance, or private placement, they're here already. You know, we've always been able to do that in the UK. What you're talking about are funds in the IPO context. You're talking about funds which may get involved a matter of months pre-IPO. You know, I'm not going to name names because otherwise it'll think I'm sort of pointing people towards it. But there are plenty of big institutional investors. You've seen a lot of the names on the charts that I've shown. Have the capability to do that for UK companies.
Because again, that's another one of those kind of aspects that gets thrown out when a lot of the discussions I hear is like, oh, we need more crossover investors like they have in the US. But as you say, maybe it's a terminology thing. They're just looking at.
Well, look, again, it's no secret. It was born out of the Edinburgh reforms, yet another set of reforms. But we are, we the exchange are, we have the platform already, but we're working on the regulatory piece. We are building what's called an intermittent trading venue, which hopefully will be up and running about this time next year. And that is going to be for initially UK companies who seek secondary liquidity at scale. So it's going to be for bigger private companies who want to do exactly that. And needless to say, the private equity industry, both here and abroad, is very interested indeed, because they're going to get sight of opportunities which they wouldn't otherwise see.
And I think, you know, another sort of positive aspect I felt was seeing funds like OrbiMed, Flagship, putting down physical presence in London, which kind of is that. Do you think that's being encouraged or accelerated to some degree?
Accelerating quietly.
Reforms?
Yeah.
You know, it's like,
but
okay,
again, you know, there's no barriers. I mean, even with UK outside of Europe now. I mean, you know, we had Jefferies a couple of weeks ago. It was heaving. International investors. And we've got JPM coming up in January. I'm hearing that's going to be quite busy this year. So You know, I don't think geographic barriers necessarily apply as much as they used to. And I make the point again that if, and it's a big if, it's UN visitors you seek, the chances are they can do it through London quite freely, be it private or public.
Yeah, and I speak and hear from a lot of the US investors or commentators or analysts or brokers, and they know we're perfectly comfortable investing in London.
Yeah,
Bring us the assets we want to see. But then it's, you know, there's this sort of gradation from the valuations that work on AIM and can do the follow-ons and keep growing their value.
Yeah.
And going up that pipeline. And I guess it's going from AIM to main, I think was something that was a phrase used a lot.
You can do that. Again, it's relatively straightforward. But then you've got to ask the question, you know, again, it varies company to company, but I give you Abcam, a sad story for the UK, because forget about how they got themselves into the pickle that they got into, but you're talking about a £3.5 billion business built from scratch in Cambridge. Jonathan Milner, long before he stepped back, he had actually created a cap table which was 60% North American institutional investors. They intentionally kept the AIM listing because the original tax efficient investors still in there would have to be unwound. They got all the capital that they needed, didn't matter they were on AIM. But the other thing which was quite interesting about that outcome was that although it was sold, I'll let you decide about whether it was cheap or expensive or good value, to Danaher, actually, you know what? London stock market played its part in the growth of that business. The fact it went out to the trade, it was a £3.5 billion business which started life as a 60 million IPO, and I think from memory only raised about another 80 of capital during its lifetime. The other interesting thing about that, which we haven't touched on, is that one of the things about the US is that, quote unquote, there are many more knowledgeable analysts. There are many more by virtue of it being a much bigger market with more moving parts and more banks and brokers. Abcam discovered when they switched to their NASDAQ listing at 3 billion value that they retained more London analysts than they picked up new in the US.
But I mean, that's kind of interesting because one of the sessions in the Genesis Fringe we did this morning, and there was an analyst was part of that discussion.
Yeah,
and I raised this question because over previous meetings, one of the challenges about, you know, if there's a big influx of money coming in from the mansion house movement, then we don't have enough analysts to advise the pension funds.
Yeah, but that's not just this sector, Tony. This is
I think
another review, the Kent review, which has relatively recently put forward its recommendations, and this is much more about the availability, the provision of research coverage for the small mid cap. So again, the nothing to 500 million territory across all sectors.
The response to that really was the fact, well, you know, there are very, very good analysts here, and
yes.
You know, it's not as if we don't have analysts in London. They do know what they're doing. And
I know.
I think the guy maybe stretched it a bit far when he said, "Look, I've done so many dermatology companies of late that I'm starting to feel like a dermatologist." But it's, I think there's only so much you can learn on the way.
Yeah, but interestingly, the other thing, again, our broad brush description, healthcare. What we see with UK institutional investors is that a healthcare company listed in London will also pick up coverage from tech investors, tech analysts, and also generalists as well.
Yeah. And I think that's the other side of this. Sometimes it's about, you know, and it's something that obviously One Nucleus as a membership group will think about with its members is what sort of knowledge sharing and question provoking and thought provoking things can we do that means companies are as prepared as they can be for some of these decisions. And, you know, this sort of the earlier meeting I referred to was all about doing the housekeeping well.
Yeah.
When you are going through due diligence and you've chosen to go route to go public, and it's no different if you're going into a private investment round, it's just making sure all the bases are covered. It doesn't start getting picked apart for all the wrong reasons.
One of the things, two things that I come up against a lot and routinely make introductions to the right sort of people is companies that are scaling and they've sort of hit that crunch point whereby They probably need to think about upgrading some of their advisors because they're trading beyond the UK and need to be able to execute on the ground in countries and so on. So typically lawyers and multi-point accountants enter the fray. But the other thing is that a lot of the housekeeping, as you call it, the preparation, the scaling, making sure the business and its systems, governance and everything else is robust, is actually common to any other type of investment that companies seek, VCP and so on. And the more you can do yourself, the better, rather than find an incoming investor who says, well, this is how we're going to do it, this is how it's going to be.
Yeah, and I think I guess it's anything anyone can do that enables businesses to be confident in their own views of what.
And I find that the sort of the mid-sized firms of particularly the accountants, outside of the big four, they are, I'm not saying doing pro bono work, but they're always very happy to sit down and talk through where companies are at, what good practice looks like, what they need to think about now, next year, the year after, because two big things which are hitting all industry sectors now. ESG.
Yeah.
And it is ESG is the big thing. And it's not just affecting very large companies. Depending on who you talk to, it's also affecting very small companies too.
Well,
so gone are the days of having a sort of, right, well, we've cut and pasted a statement and put it on our website, job done.
Yeah, that's right. And I think that's the bit, that I find we hear ESG come a lot, but some of the things in the governance bit, if you like, of ESG, they're not quick solutions to do if you've been prepared for them.
No.
And I think that's one of the things that trying to work with businesses with yourself, like the ones you feel are the ones that are right to go to market, is getting your house in order early. It's a long term.
Just a bit of an aside, but talking about funding continuum and infrastructure and everything else, we had an event last week at the Exchange, which was really a technical update for the VCT industry. So on the one side we had VCT investment managers and directors, and on the other we had the London-based brokers who turned to them for funding for both private and public companies. Interestingly, the big message from the VCT community is they have got a huge amount of money to deploy for qualifying companies. Because as you head into the end of every tax year, they do another raise when they haven't actually spent the previous years.
Yeah, that's true. And so I think there's lots of reasons. I mean, you've talked us through a number of them of reasons to be optimistic. For sure, there's going to be some challenges ahead.
Well, look, we are. If it helps, we are starting to see companies either restarting IPO processes which stalled 22 into 23, but also we've had some brand new ones pop up who, in the recent weeks, who are saying, we've appointed advisors doing this, doing that, and we're hoping to get it done by the end of Q2 next year.
I guess that's something on my sort of radar of things, because reasons to be cheerful. There are some unknowns down the track, or in terms of unknown effects. We've got politically the elections in the US next year. Who knows what that will mean? What will it mean in the UK? I don't get the impression that anything I'm hearing from different colours of party in the UK that we'd expect that much to change in a sense of.
I don't think so. I mean that's roughly what we're hearing as well. I mean, we even had Starmer in the House the other day admiring Mrs. Thatcher.
Oh, well,
so
that would have been popular with his colleagues a while back, that's for sure.
Yes.
That's right. That's sort of kind of where we are with a lot of this. And I think one of the things, I guess, making new medicines, developing new healthcare, it's difficult in just about every aspect. Otherwise, we'd have solved every illness by now as an industry. But putting more barriers in the way doesn't help. But I get a real sense at the moment that the political will and the will with the main stakeholders in the markets in London are really on the same page of taking.
They are. And I mean, look, not me personally, but as an organisation, we see this at first hand. And what is very clear is that there is a will to change, not least of all because, the UK is having to work far harder than it did before outside of the EU. But also you've got, at the moment specifically, you've got Hunt and Sunak, who both of whom understand business, finance, and economics very well.
Yeah, yeah, and I think that's something that we have to hang on to, I think, in our minds, and not worry about things that aren't a problem yet, and just celebrate the things that someone has got their heads around this collectively.
Yeah.
So, and for the UK's productivity to go up, we need to see the UK capital pools owning more equity and business, and that's just macroeconomics at a fundamental level. We're not holding enough. So I think it feels to me like lots of incentives are there to build on the very positive foundations you just presented. And I'm hoping in maybe 12 months from now we'll be having this conversation again and we'll say, look how wonderful it is.
Well, no, but that's the other thing. Because I spent 25 years in broking and investment banking, so I've seen a few peaks and troughs. And the reality is that first of all, the market always comes back. It always does.
Yeah.
But the thing is it can come back very quickly indeed.
I think that's the thing, isn't it? It can change really quickly, and I think that's the thing that I'm guessing. Even when you look at the number of companies that have been conserving cash and holding back, and they're primed to go when that capital starts flowing, I think is going to be a very exciting and dynamic time. I kind of wonder for some of the ones with more and more companies queuing up behind them with even later technology and more data, and being more in vogue, if you like, in the areas they're in, is going to really pressure some of the existing companies that have been forced to hold back a bit. And I think that's probably going to raise the stakes of what the value proposition looks like.
I wouldn't disagree.
Yeah, and maybe competition in that sense, there's never enough money to go around. Otherwise, we'd all be millionaires making money and raising it easily. But equally, there's an argument, I guess, that competition is what keeps the real quality up and builds confidence with investors.
Yeah, but the other thing, as with healthcare and science, as with technology, investors are always interested in the next offering. It's a question of whether they feel it's the right one for them to be investing in, but they know there's going to be more coming down the pipe.
They know there's going to be something else coming, I guess. And I suppose from an investor's perspective, is that something else going to undermine the thing I could be investing in this week if I don't have to, I suppose.
Well,
but then you can't forever. So
that's one for them. They are the sophisticated investors who do their diligence and make decisions, not us.
And again, I suppose it's something else that we probably don't celebrate enough is the quality of investor base we have and how sophisticated the market is with all its stakeholders and capital holders. And I just don't see necessarily any reason why we shouldn't be optimistic.
Yeah. And I think again, I say for earlier stage growth stage scaling businesses, show me somewhere else in the world where you can, if you go down the IPO route, you can start life as a 50-75 million pound company, and you can have some of those big blue chip names on your cap table. And that's scalable, high quality capital.
Well, I think that's the thing. It opens so many doors after that to scale.
Yeah,
I think that's the exciting part. Tim, I'm conscious of your time.
I'm fine. But we've had our hour. Sadly,
we're at our hour. We could talk about this for all day, I suspect. But I'm sure we'll be back to have these conversations again. But for now, thank you very much for sharing that, and I'll look forward to seeing and catching up over a beer where we go.
And thank you, Tony. We appreciate the opportunity, because there are a lot of myths out there, but we are very, very much open for business and very keen to have these conversations, even if it's a thanks but no thanks.
I think the phrase of "show me somewhere else you can go that's better," I think we should really hang on to that. So thank you very much, Tim.
Thanks a lot. Thanks, everybody. Bye.